and welcome to Capri Global Capital Limited Q3FY23 earnings conference call hosted by Go India Advisors. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ravikant Bhatt from Capri Global Capital Limited. Thank you, and over to you, sir.
Good morning, everyone. This is Ravikant. I shall read out a brief disclaimer for today's call. The discussion on today's call regarding CGCL's earnings performance will be based on judgments derived from the declared results and information regarding business opportunity available to the company at this time. The company's performance is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially in future. Given these uncertainties and other factors, participants on today's call may observe due caution while interpreting the results. A separate disclaimer is available on slides 2 and 3 of the Q3FY23 investor deck. Participants are requested to note the same. I now request our MD, Mr. Rajesh Sharma, to present the opening remarks. Over to you, sir.
Yes, good afternoon, friends. And like always, it is a pleasure to welcome you all to Capri Global's post-earnings conference call. Let me start by wishing you all a happy new year 2023. We declared our reviewed consolidated results for Q3 and for 9 months FY23 on Saturday, 28 January 2023. I hope you had a chance to go through the investors deck. With our right issue proceeds yet to be concluded, we will have to refrain ourselves once again from giving specific forward guidance. I hope our discussions today around CGCL's performance during Q3 and 9 months FY23 will provide you all with the sufficient clarity and cues to understand the directions of company's progress. In this commentary, all references to profit and loss and balance sheet aggregates as well as the ratios shall refer to consolidated value. All reference to urban retail shall mean MSME and affordable housing. As you would have noted, we have reported a decline of 42% year-on-year and 14% year-on-year in our Q3 FY23 and 9-month FY23 net profit respectively, driven majorly by the cost we incurred in the gold loan vertical. I shall elaborate on this later in this call. Let me first start with our business performance. Please refer slides 6 and 7. Asset under management increased 49.9% year-on-year and 11.4% quarter-on-quarter to touch 86,525 million. The share of retail loans improved to 79.1% from 74.4% in Q2 FY23. The share of construction finance segment where growth was stronger in H1 FY23 due to a strong sanction disbursal pipeline softened during this quarter by 200 basis points. Quarter-on-quarter to 19.4%, below our threshold of 20% at consolidated level. This is in line with our previous commentary that construction finance momentum shall be softer in H2 FY23. Disbursal touched rupees 18,105 million, growing 43.1% year-on-year and 21.7% quarter-on-quarter. Disbursal for 9 months FY23 stood at 43,917 million and were up 57.9% year-on-year. The share of retail disbursal comprising MSME, affordable housing and gold loans was 75.5% in Q3 FY23 compared to 47.7% and 35% in Q2 FY23 and Q1 FY23 respectively. Gold loan led the momentum in disbursal during Q3 FY23, constituting rupees 7,741 million or 42.8% of total disbursements. This translated in gold loan AUM touching rupees 7,152 million, constituting 8.3% of total AUM compared to a 1.8% share in Q2 FY23. This rapid scale-up was supported through an expansion of exclusive gold loan branches, which increased from 182 in Q2 FY23 to 449 in Q3 FY23. I shall discuss the cost impact in our commitment to this business while discussing the earnings performance. As part of our growth strategy, We continued expanding our urban retail network deeper and in contiguous geographies. We added 15 urban retail branches across Rajasthan, Uttar Pradesh, and opened our maiden branch in Bihar in the state capital Patna. Our non-gold loan branch network stood at 160, up from 145 in Q2 FY23. Our total branch network stood at 609, up from 327 in Q2 FY23. Details on our network expansions are given on slide 29 and 30. The car loan distribution business continued with its strong momentum. As shown on slide 12, the loan originations touched 16,920 million, up 3.1 times year-on-year and 24% quarter-on-quarter basis. Total origination in 9-month FY23 stood at 39,975 million, over 2.3x FY22 originations, which were 17,022 million. I shall discuss the fee contribution from the vertical while commenting on our earning performance. As of Q3 FY23, the car loan distribution business had a presence in 322 locations in 29 states and union territories, unchanged from Q2 FY23. The vertical has 6 exclusive branches at all other locations which operates through a feet-on-street sales force. I shall now turn to earning performance. I shall be referring to slide 14 to 17. The net interest income or NI increased 17.5% year-on-year and 5.3% quarter-on-quarter to 1,610 million. The net interest income in Q2 FY23 was boosted by certain one-off components amounting to 130 million attributed to recovery. Adjusted for the same, the net interest income increased 15.1% quarter-on-quarter. The net interest margin computed on average net advances was 8.45%. Adjusted for the one-off item in Q2 FY23, the net interest margin was up 34 basis Q&Q, while the unadjusted NIM declined 41 basis quarter-on-quarter. The near-term pressure on net interest margin has been higher on account of a lagged repricing of loans compared to borrowing. We expect that net interest margins to stabilize as our incremental loan mix changes in favor of higher yielding loan as well as the repricing of existing loan book. Let me now turn on non-interest income. During Q2 FY23 earning calls, we offered some historical perspective on CGCL's non-interest income, which has seen its shares in net income rise from an average 14.5% between FY18 to 20 to 26% in H1 FY23. The non-interest income has become an important structural earning driver for CGCL, contributed by 2 key product lines: the net fee income from car loan distribution business and number 2, the income on assigned portfolio under co-lending mechanism. Continuing with this analysis, I am pleased to inform the share of non-interest income to net income improved further and stood at 32.4% and 28.6% respectively in Q3 FY23 and 9-month FY23 respectively. The car loan business contributed rupees 333 million and rupees 800 million in net fee during Q2 FY23 and 9-month FY23 respectively. The income from co-lending portfolio constituted rupees 200 million and rupees 385 million, or 8% and 6% net income in Q3 FY23 or 9-month FY23 respectively. I would like to mention here that presently we are not targeting any particular mix of spread and non-interest income. Both the non-interest income streams are doing well and have a strong growth runway given the scope of our intermediation and bank partnerships. I shall now turn to the operating expenses. Please refer to slide 16. Since the beginning of this year, we have not given a specific guidance on cost-income ratio. We have generally said our cost ratio shall remain lopsided on account of our aggressive expansion plans. In line with that, the cost-income ratio got pushed up further to 69.5% in Q3 FY23. As highlighted in slide 16, adjusted for the expensive income in gold loan vertical, the cost-income ratio would have been 47% in 9 months FY23. Based on our internal classification, we estimate a loss before tax of 975 million in the gold loan vertical in 9 months FY23. We have slightly modified our cost average AUM ratio graph to include an additional line graph. We have presented costs divided by average AUM ratio by including the car loan origination volume during respective quarter in the average AUM definition. This is a better perspective as the employees' expenses incurred on the car loan vertical is captured in our OPEX, while the fee-generating car loan is not part of our AUM. The cost divided by average AUM ratio has risen to 329 basis in trailing 1 year, while the cost average AUM ratio, including new car loan origination, has risen by 234 basis in the same period. I would also like to highlight that we had already onboarded a significant number of staff for gold loan vertical branch rollout in Q2FY23. This was to ensure bench strength ahead of the planned rollout in Q3FY23. Hence, the average headcount in gold loan at the beginning of Q3FY23 was 13 branch. It normalized to 7 branch by the end of Q3FY23. This contributed to the increased employee OPEX in Q3FY23. The necessity for such pre-rollout hiring has now reduced. With our initial presence getting established, we had planned a gold loan branch count of 556 in FY23. Having rolled out a significant number of planned branches in 9 months to FY23, the incremental employee additions and OPEX intensity should soften in Q4 FY23. Now I am coming to credit cost and asset quality. We reported a net credit cost of 245 million in Q3 FY23. This includes rupees 188 million net write-off and rupees 57 million in ECL provisions. Despite the spike in Q3 FY23, the cumulative credit cost in 9 months FY23 was rupees 530 million. 50% of FY23 credit cost of rupees 1,057 million. The 9-month FY23 annualized credit cost stood at 94 basis compared to 124 basis in 9-month FY22. The stage 3 asset increased to 7.3% or rupees 130 million QoQ to touch rupees 1,911 million. We expect cash recoveries from some of these slipped accounts in Q4 FY23. The stage 3 ratio stood at 2.36%, 66 basis year-on-year and 4 basis quarter-on-quarter. Our provisions on stage 3 assets were 29.1%, marginally better than 28.7% in Q2 FY23. The standard restructured asset stood at rupees 1,454 million, constituting 1.8% of AUM. Approximately rupees 1,100 million plus of restructured assets have exited moratorium, and another rupees 350 million shall exit moratorium in Q1 FY24. The cost drivers discussed earlier in the call subdued profitability in Q3 FY23. Our consolidated net profit after tax declined 42.3% year-on-year and 13.5% quarter-on-quarter to be 374 million. The 9-month FY23 net profit was lower 14.4% at rupees 1,319 million. Excluding the direct cost incurred on the gold loan vertical, our Q3 FY23 and 9-month FY23 net profit would have been higher by approximately 32% on year-on-year. We reported a capital adequacy ratio of 24.2% for CGCL and 38% for CGHFL. The proposed capital infusion through rupees 14.4 billion right issue will timely and augment our growth equity. We hope to communicate the timeline of the capital raise in near future. With that, I conclude my commentary. We shall now take questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Uday Pai from Investec. Please go ahead.
Hello, thank you for the opportunity. I have 2 questions. What will be the gold loan yield on a steady state basis, since it is at 15%, which seems low right now? And what is the quarterly disbursement in gold loan that you are targeting?
Yeah, can you repeat the question? There is a lot of background noise is coming.
One second. Yeah, so what would be the gold loan yield on a steady state basis, and what is the quarterly disbursement of gold loans you are targeting?
So gold loan we announced the rollout. The beginning, you have to add a lot of customers. Our yield in the range of about 15.5%. But slowly it is going up. So when the retail customer segment is increasing of the low ticket size, the yield will start going up. Our target of the yield will be in the range in the region of 19%. So gradually we'll see our yield is inching up. In Q4 and next year, FY23 quarter one, you will see the yield improvement significantly when the branch gets some vintage. And we are targeting the gold loan book to close in the range of about 850 crore in Q4 FY23, and will continue to grow depending on the branch rollout and everything else. But we are targeting about 3.5-4 crore rupees per branch AUM within 15 months from the date of its starting operations.
Sure, sir. Thanks. That's it from my side.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Gaurav Sharma from HSBC. Please go ahead.
Yeah, hello. Am I audible?
Yes. Please go
Hello.
ahead.
Thank you, sir, for allowing me the question. Congratulations on a great set of numbers. There are 3 questions. So one is like, sir, your AUM mix is shifting towards gold loan and shift from MSME is coming. So just wanted to know the steady state mix of your AUM. That is one. Second is like, sir, in gold segments, some of the bigger NBFC players mentioned that they are also getting aggressive. They are also expanding their standalone branches in gold. So how you see the competition and how you gonna cater that? How you gonna counter that? And third, my question is related to the car loan discussion. It's showing a great momentum. So, and you have mentioned that you are just 6 branches and you are operating at 322 locations. So just wanted to know more about your operating model in this segment, and if you can describe the OEM mix in that, like which are the largest contributor in this fee income, it will be really helpful. That's it from me.
So if you talk about the competition in the gold loan, yes, there is a competition, but there is a market also growing. The market of about 350,000 crore is growing at the pace of 12%. And majority of growth is still contributed and catered by the NBFCs. So to build a book of 10,000 crore, which you had said earlier, in the next 4 to 5 years, should not be, given the size and given the growth coming up, should be a problem. And it depends on how fast you build a brand and how fast you quickly build a confidence among the investors, borrowers to come and take the loan from you. So for that, we are continuously doing our radio campaign. You must have seen that even cricket team, Gujarat Lighting cricket team, we have taken the sponsorship showing the Capri loans. So various the campaigns are going on to build that brand, and I think that is showing up. We have built a very fast 700 plus crore of AUM, and within less than 6 months. So I think it is very credible as far as I am concerned. So we feel competition is there, but market size is growing. If we talk about car loan, it is a purely fee income where the referral is given to the bank and we assist the borrower to have a hassle-free disbursement in a fastest turnaround time. So it is a mix of technology and feet on the street. While the branches are 6, but we have our connector model also. So we get the lead, we use some sort of a technology there, and we use our local feet on the street, combine both. And I think we are one of the largest player in this segment, and fee income is directly contributing to the bottom line. So we work on the unit economics as well. This year, I think we are targeting a fee income of 100 crores, and it will significantly contribute to the bottom line.
And sir, last one on the steady state of AUM mix, what will be the share of gold loan and MSME?
So I think initially it can be depending on the branches, but if you talk about 4 to 5 years, how it look like that gold loan will be about 25% of AUM, and 25% of AUM will be MSME, and about 30% will be your home loan, and about 20% will be construction finance. That is how it look like.
Okay. Thank you so much, sir. That's it from my side. Thanks a lot.
Thank you. We have our next question from the line of Bunty Chawla from ICICI Capital. Please go ahead.
Yes, sir. Thank you for giving me the opportunity. Just few queries. Firstly, what is the incremental cost of borrowings in Q3 FY23, and how we are seeing that shaping up in Q4 FY23? And similarly, what will be the impact on the margins as a whole?
Can you repeat the question? The voice is breaking.
Okay. Is it audible now?
Yeah, it's better.
Yeah. So, firstly, what is the incremental cost of borrowing for us during this quarter, and how the cost of fund will shape up in Q4 FY23? And similarly, what will be the impact on the margin front going forward?
So our cost of borrowing for NBFC is in the range of about 9%, which has gone up by about 70 basis from 1 year ago. And our cost of fund for Q4, for our housing finance cost of fund, which was earlier about 7.25%, has also gone to about 8%. If you talk about the cost of fund, it will remain in the same range. And we are able to pass on to our new borrowing are happening at the increased rate. And all the customer on the floating basis, we already passed on this hike. Only customer where the fixed loan for 3 years, we are not able to pass on that rate, because that is how that has been designed. So cost of fund will not be able to put pressure on the bottom line beyond that we are not able to pass on to certain segment of the customer. And I think this is a cycle. When the interest rate goes down, then those segment of customers still continue to pay at higher rate. And when the cycle is going up, still the customer enjoys. So on a longer term, those set of customers do not create much of the problem for the bottom line. But why we will give you fixed? Because it helps to retain the customer for a certain period, because we incur a cost on that. So based on the category of customer, we offer floating and fixed. So cost of fund increase will not put any much pressure. We are already have passed on to the customer, as well as the new loans are booking at the increased rate of interest.
Okay, sir. And so similarly, in the liability mix, if you see, the bank borrowing has increased. So are we focused more towards bank borrowing? Is there any specific reason?
First of all, the bank gives long-term money, about 7 to 8 year money we can have from the bank. And PSU banks' cost of funds is cheaper to us as compared to private sector banks. So if you see what rate of interest the State Bank can offer, perhaps the mid-size private sector may not offer. So we always see who can give long-term rate loan and who can give a better rate of interest. So these two criteria we go for our borrowing mix.
Okay, so that was very helpful. So lastly, just yesterday there was last week Bajaj Finance has shared, similarly as we are going aggressive in gold loan branches, in gold loan focus. So how should one see that in our overall market pie? Is it that increasing, or it's altogether different? They are focusing as we are focusing. How one should see versus Bajaj Finance in terms of gold finance?
So I think any sector which is offering a margin, there will be a competition. Competition will increase, but we have to drive a comfort from that overall market is also growing. So it is not that the market is stagnant and more players are adding on. So if 3,50,000 crore market is growing 10-12%, I think that is offering good room for the new player to come in as well as the new existing player to grow their book.
Okay. Thank you, sir. That was very helpful, sir.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Ashish Kumar from Infinity Alternatives. Please go ahead.
Thank you, sir. Sir, a couple of questions on the gold loan business. One is you mentioned that in each branch you're targeting 3.5 to 4 crores of AUM. So what kind of an OPEX as a cost to AUM will you be having at that once we achieve that?
If you talk about cost, I think every branch will have a cost in the region of about 2.5 to 3 lakhs a month. So we break even every branch at 3.5 crore level on an average basis.
Okay, and so basically, for us to be able to hit our numbers in terms of profitability, let's say a 5% NIM, correct? We would need to at least have maybe 5% PPOP. Sorry, what I mean is at least 6.5 crores per branch. 6.5.
I may not be able to answer that immediately because I have not analyzed it that way. But after 3.5 crore rupees, you start making, and it starts directly add to the PBT, I would say. So if you build a AUM of 6 crore rupees and assuming those cost parameters, then on the balance 2.5 crore rupees, we should be able to make about 25 lakh rupees of a operating profit.
25 lakh rupees of operating profit per branch, which is roughly 4%.
Yeah.
And a 3% ROA. So the second question was in relation to the whole competitive scenario. In gold loan, you've seen traditional market standalone leaders like Muthoot and Manappuram struggling to grow their AUM. From a timing perspective, given the fact that we are looking at 3.5 crores, maybe in 18 months, 15 to 18 months time, is it the right time to enter into this business? Because everybody, including the banks, have become super hyper competitive in this space. So, do you think it makes sense for the competition to reduce a little bit? Because, like we've seen in the past, every time a few people enter in and some people figure out that they can't make money on this business and exit the business. The banks get busy with the larger ticket size lending. So purely from a timing perspective, does it make sense for us to wait and rather than go so aggressive in terms of the gold loan branch opening, or do you think?
So our belief and analysis says that if you want to enter into gold loan, you have to have a wider branch network. It's a very small ticket size, 80,000, 90,000, 50,000, 1 lakh rupees kind of a loan. So unless you have a size, you cannot make profit out of it. And you should be able to absorb the first 15 months operating losses every branch will throw. Unless the branch reaches the break-even point and start building AUM thereafter, you will not make money. So that kind of a capital allocation is required. So in some way, it is an entry barrier for a smaller player to do gold loan. So still, if you see Muthoot and was reaching the 12 crore rupees per branch, even though they are able to maintain, they are super profitable in terms because they are in this business since long. So any branch which is reaching at a 7-8 crore rupees above upward, that will start delivering them the higher profit. And any segment which is offering profit, it is natural to attract more player and more competition. But still, it is all about your branch presence, your ability to build a confidence among the borrowers, and these are the two factors help you to build a high AUM. We are quite confident that we have MSME, we have home loan, we have car loan lead referral business, and the gold loan. So there will be some sort of cross-selling will also be possible. So we have to work on the cost efficiency also. And with the multi-product, we have to believe in the cross-selling aspect. Combination of this, I think this business also on the plus positive side that if your processes are set, then you accelerate it. I think you need not to worry about the delinquencies if your processes are set. So there are every plus and minuses, but overall it is an attractive business model to follow. If you are able to continue to expand your network and achieve a size.
I understand where you're coming from. I was coming more from while from the absolute amount of profit pool, I agree with you completely, and I understand. I was coming more from an ROE perspective because, frankly speaking, somebody like Manappuram, who's been for so long, is struggling to get to a mid-teens kind of an ROE. So anyways, I understand where you're coming from. Thank you, sir, and wish you all the best.
Okay, thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We have a next question from the line of Gaurav Somani from Korman Capital. Please go ahead.
Hello, thank you for the opportunity. Sir, can you share the mix of lending in terms of fixed and floating which we have? Hello?
Our borrowing?
No, lending, sorry. The assets, the lending which you have done, currently what is the mix of floating and fixed loan rates which we have?
Ravikant, will you be able to share that detail, please?
Gaurav, so most of our borrowings are basic.
The loans which we are given, basically.
If you could just repeat it.
So my question is, the loans which we are given, can you share the mix of fixed and floating which we have in the?
So gold loans would be entirely fixed. They reset only on at the end of the tenure. As far as the other loans are concerned, housing and MSME particularly, these are resettable. So basically, we give out loans that are fixed for a tenure up to 3 years, and after that they become floating. So typically in a year we would have about I would reckon 25 to 30% of the portfolio at least coming up for eligible for repricing. And construction finance, the resets can happen more often.
Okay. Thank you. Sir, my next question is on our cost to income ratio. In the past, you have suggested that the cost to income ratio will hover around 60 to 65%. This quarter, we have touched around 70%. So any view on once the gold loan business, where do you see this normalizing probably a year or two down the line when the gold loan business stabilizes?
Hello?
Yeah.
Can you repeat the question, please?
Yeah, sir, my question is on the cost to income ratio. It hit 70% this quarter. In the past, you have said that it will be around 60 to 65%. So where do you see this normalizing once the gold loan business stabilizes? Basically?
So I think we have to see that had not been gold loan, profit would have dedicated to P&L account. This cost income ratio would have been in the range of 47%. Mm-hmm. So if we talk about overall cost to income ratio vertical wise, so MSME in home loan, our aim will be to bring it to in the range of about 35-36%. And if you talk about gold loan, it will be in the range of about 45% kind of a OPEX. And if we start doing cross-selling and also the BC arrangement and co-lending in the gold loan, that will completely change the dynamics. While we are not saying that when it will happen, but I think next year we'll have a few partnerships in the gold loan of co-lending and BC where we'll use our network to originate this for the loan so that we'll be able to compete with the even lower segment of the gold loan customer. So that dynamics of the cost-to-income ratio will completely change in our favor in a larger way.
So we see this stabilizing below 50% probably a year down the line.
Yes.
Sir, lastly, on the co-lending aspect, if you can share the amount of co-lending which you have done till now.
So co-lending till now we have done in the range of about 450 crore rupees.
450 crore. Okay. And and what is our view on this business? On the co-lending business, we want to grow it or we want to do it on our own book?
No, we definitely want to do co-lending business and we want to grow this. At the moment, a technology interface with the banks are underway. Once that takes up, the volumes will increase significantly. And this has an edge where we get a cheaper rate and the risk is shared. We originate and we collect and we get a fee. So while on the profitability side, it has no impact, but on the allocation of capital, you are not required. So it becomes very, very highly ROE accretive.
Okay. Thank you, sir. That's it from my side.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Karthik Kara from Multiple Wealth Management. Please go ahead.
Thank you. Am I audible?
It is not loud, sir. Can you use the handset, please?
Yeah, 1 second. Yeah, hello. Is it better now?
Yes, please go ahead.
Yeah, thanks for the opportunity. One question on MSME. So, in terms of the percentage mix of the MSME disbursals, it's clear because the gold loan has been quite sharp, the increase in gold loan. That's why the percentage disbursals share has reduced. But even the absolute amounts for last 2-3 quarters has been lower compared to previous periods, the MSME disbursals. So can you throw some light on that? What is our thought process? Are we deliberately going slower or what's the scene out there?
So there is no thought process to slow down the MSME disbursal. If you see our disbursal has not slowed down, the other verticals have also picked up. So you might be seeing that our disbursal overall MSME have come down, but that has come down because the gold loan has also come up. But if you see our branch network is increasing, if the branch network is increasing, the disbursal in absolute terms is increasing only. So it is all-time high disbursals are happening in all the segments.
No, I'm looking at slide 7. So if I take say Q3 and Q4 of last year, the MSME disbursal was 3,600 crores, 4,200 crores. Versus that, this year for the 3 quarters, it has been 1,800, 3,100 and 2,800 crores. So that is where I was coming from.
Ravikant, will you check that? Because I'm not on.
Yes, sir. So what has happened is basically, we have combined teams for both MSME as well as housing. There is a certain stiffness as far as MSME is concerned, both on the pricing as well as the overall growth. This is more of a momentary thing, and therefore we had focused slightly more on the housing side. So quarterly, there could be some dissonance as far as the growth is concerned. But as Mr. Sharma said earlier, both MSME, all the three MSME, affordable housing as well as gold loans would be key retail growth drivers for us. So don't read too much into what has happened during second quarter. And overall, again, if you see how the MSME portfolio has performed, it's up 30% YOY. And you have to look at it both on book plus the assigned portfolio, where the assignment has been slightly higher during the third quarter. So growth is happening. It's just that it shifted a bit to some other segments, but it could return once again going ahead. So we will be focused on all the three products as far as the growth outlook is concerned.
Okay, fine. And another question on the housing loan segment. So how is the ticket size been moving for us in this segment? Can you throw some light on that?
Hello?
Hello?
Yes?
Hello? Yeah, so I was asking my second question, which is on the home loan segment. How has the average ticket size been moving in this segment for us?
The average ticket size range of about 12 to 13 lakh rupees. And if the housing prices are growing, it might at the most can reach about 16, 17 lakh rupees. It is not going to significantly change since we are in the affordable housing segment.
Right. All right. Yeah, those are my questions. Thank you so much.
Thank you. We have our next question from the line of Praveen Moore from ICICI Securities. Please go ahead.
Yeah, thank you for taking my question. So just a continuation of earlier question that how we are seeing the incremental demand in MSME segment. I mean, any specific segment or geography we are seeing the strong demand. And sorry if I missed this. What is the quarterly disbursement rate we are targeting?
So if we talk about the demand is depending on our branch network. So suppose we have more branches in Madhya Pradesh, then we see the stronger disbursal happening in Madhya Pradesh because our branch network is more. But our rest of Maharashtra branch is lesser, so we will see lesser disbursement. So it is sometimes a function of our presence also. And if we talk about our disbursal, I think always MSME we have seen the disbursal of in Q3 about 286 crore and construction finance 278 crore rupees. So if we see this disbursal in last quarter of year happened highest, so it increases quarter on quarter. First quarter of the year is always lower and the last quarter is always highest. So in that sequence, disbursements happen because there are always loan demand and it is a push product, so it happens and it happens across all NBFC in banking system. So I think we should be growing our MSME portfolio in the range of about 25% plus this year as well.
Okay, thank you, sir.
Thank you. Participants may please press star and 1 to ask a question. As there are no further questions, I now hand over the call to management for closing comments. Over to you, sir.
Yeah, thank you. So, as we said, we have always stuck to our core philosophy to build a customer base whom banks are not catering. So we do MSME where customers do not have income proof. We do affordable housing in the same sequence. In fact, thought process we added the gold loan. And for the fee income, we are doing very well in the car loan distribution. I believe that next 2 years, once our gold loan expansion takes place and every branch started delivering contribution, and at the same time our MSME and affordable housing portfolio will also grow. Our operating cost will come down, and there will be great fee contribution from the car loan and the advertising income of the insurance products. So I think we are inching towards a higher AUM and better profitability. Technology, we are making a lot of investments and data science team. We have added about 15 people we are having. We are pinpointed. They are analyzing every geography, every product, everything, and they are making a sea change. That will also help us not only in our asset quality policy but also in cost income. So overall, we are quite confident that we are on a path where we should be able to deliver better returns for our stakeholders. So thank you all of you for joining the call.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
The conference is no longer being recorded.